Welcome to the Accounting Bible. You've came to the right place to understand accounting in an easy and simplified way. If you find this video helpful, share it with a friend, hit the like and subscribe button. To start off in accounting, you have to understand the fundamental accounting formula, which is assets equals liability plus equity. To be able to understand it and to understand how it affects accounting in general, and how it helps you understand accounting, you have to understand and know about every aspect inside it. You have to know what's assets, what's liability, and what's equity. Today we're going to talk about assets. Assets is basically what the company owns. It's divided into current assets and non-current. Current assets are expected to be sold or used within 1 year. They consist of cash, which is basically the monetary currency you have on hand, or cash equivalents that are short-term commitments. They are easily convertible into a known cash amount. So it's a security, basically it's securities that are liquid and have a maturity date that's less than 90 days. Accounts receivable is when you sell a certain product to someone and they haven't paid you yet, so you book it on account and you hope to recover the amount later. Inventory is the range of finished goods or goods used in production. Let's say you're a bakery and you put flour in a warehouse. So this warehouse full of flour is considered as inventory because you have to use the flour to produce bread, for example. Prepaid expenses. Let's say you're a new business. You're opening a new business and you want a building to do your business in. So you found one and you've rented that building for 3 years in the contract. And you've paid in advance the full first year. This first year expense is considered as prepaid and is considered as a current asset. Non-current assets are long-term or expected to be sold or used after 1 year, such as investments. Investments is the process of buying a security. What's a security? It's an ownership in a publicly traded corporation. You could be a creditor with a governmental body or a corporation. What does that mean? That means that you're basically lending money to the government or to a corporation in return for a profit or a certain profit. These investments can be categorized as held to maturity or available for sale. If the intention of the holder is to keep this security, it's considered held to maturity. If his intentions is to sell it before maturity, it's considered available for sale security. The second example of non-current assets is property, plant, and equipment. It's just the building, the land, and the machinery. Basically, what you need to produce a product. Intangible assets are goodwill and patents. Patents are sometimes the right to produce a certain product or whatever. Goodwill, on the other hand, to explain goodwill, we're gonna imagine we are going to buy Apple Corporation. Apple Corporation, of course, it has its assets and it has its liabilities. Maybe liabilities can be some suppliers it hasn't paid yet. They are considered liability. And we are going to purchase Apple. We are going to purchase it for a certain purchase price. If you sum up the assets of Apple and its liabilities assumed in the acquisition process, you get a number. So the portion of the purchase price you paid for Apple that's higher than this number is considered as goodwill. I know it seems a little bit odd to understand, but we'll get into more details later about goodwill in another video. Other assets include pension and deferred income tax assets. Deferred income tax asset is basically when you've overpaid tax. So you've overpaid tax and you shouldn't have paid that much. So the next year you pay less. This is why it's considered as an asset. Thank you for watching, and now we are going to go to liability.